Thank you for joining us at Gentai's 44th Quarterly Dividend Distribution webinar today. And my name is Rafael Chow. I'm the Regional Director of Gentai Asset Management Corp. Now, below is the contact information at the two headquarters. One is in Vancouver and one is in Toronto, respectively. Now, Gentai Capital Corporation has been up and running for almost 10 years. We started west and we currently expand to the east. So now let's get started. Before we go into the actual content, I'd like to ensure everyone knows that historical performance does not mean future performance, and there's a risk associated with investing. Now, as per regulatory requirement, we'd like to ensure everyone understand that GMIC, a product, and GCC, a fund manager, and GAMC, our in-house distribution platform, are all under the same group company. Since it's interrelated, we'd like to disclose potential conflicts of interest upfront. Now let's take a look at today's agenda. We'll first cover the highlights of Q2, and then we'll review the macro and real estate outlook together. Since some attendees might not have heard about our product GMIC in the past, we'll also introduce GMIC and provide some data and information and case sharing at the end as well. Let's look at the highlights. So as you can see, in the last 8 years and 6 months, we've been steadily delivering quarterly payout of 2%, which translates into an annual payout of 8% net of fee distribution. Now, 8% is our target rate each year, and we never missed it. On top of that, we distribute special dividends in some years as well. Now, any extra earnings we deliver back to investors. That's how Mortgage Investment Corporation operates, including GMIC. On the right-hand side, you'll notice we have distributed approximately a little bit over 41 million accumulatively. Now, please note that for GMIC dividends, this is being treated as interest income for tax reporting purposes. Now, let's look at the highlights again. So at Q2, we have received 3.76 million interest income from mortgages we lent out, and we continue our 2% quarterly distribution, which compounds into 8.24% per annum. Now, on top of that, we continue to grow our investor base from 502 to 540, that is about an 8% growth, and grow to 168 million asset under management. So we also have, if we look at the portfolio, we have 80 loans being actively managed and sized at about 150 million as of the end of March. Now, some people might wonder, why not 100% of the money is being invested as of the end of March? Now, let me explain. Your money safety is our first priority. So we partner with over 3,000 lending agents across Canada. With a good amount of healthy deals in the pipeline, we cherry pick the best deal to put your money to use. Now, that being said, investors' money would not be idle in the portfolio for much time, as we all want to make money together. And we're very good at this, as we maintain our track record in the last 8.5 years. So let's look at the macro and real estate. So before the COVID started, the Bank of Canada rate was obviously higher than what it is at this moment. Now on the chart, you can see before COVID, it was at 1 point something. But since COVID started, March last year, has been kept at 0.25% to now. Now recently, BOC decided to maintain the rate at the same level. And without dramatic improvement at the economy or COVID outlook, there's a high chance that the low rate policy would not be changed soon. Throughout COVID, we see lots of economic activities remain stagnant or reduced to a lower level, and the result can be observed through CPI chart here. Now, CPI stands for Consumer Price Index, and a reduction in CPI means prices falling on a weighted average of goods and services, such as transportation, etc. Now, looking at the recent CPI, we can have a very good educated guess that the government will keep or increasing stimulation to the economy as the price is not overheated yet. So we can also look at GDP growth rate. Now, from this chart, we saw a major reduction in GDP at the first half of last year, and then rebounded quickly at the second half. So according to data from Stats Canada, this rebound was mainly the result of a large change in business inventories, increase in government spending, increase in business investment in machinery and equipment, and also increase in housing investments. So as we all know that COVID is not over yet, however, it shows that a lot of the business owners and a lot of investors are actually starting to see the end of the tunnel. So that's why they actually put their money back into work. Now we'll take a look at the mortgage index. So the non-bank mortgage extended has been increasing since Q1 last year. And if we're looking at Q3 last year versus Q3 year 2019, we see a 40% increase. Now we apologize as there's not yet most up-to-date data available for us to use, hence we have to use the Q3 of last year. But the growth in the mortgage extended was possibly driven by multiple factors, such as low mortgage rates and home resale activity resumption. Now I must point out right here that the growth in mortgage extended does not mean late payment increase. This simply means borrowers would want to take benefit of the low interest rate environment and potentially buy more houses. And if we look at the actual mortgage payment right here, so mortgage deferred payment at non-bank lender is actually in a decreasing trend. So at Q3 last year, there was about 60,000 mortgages being deferred, which represents a reduction of about 40% from the quarter before that. The total value of deferred mortgages also decreased by about 37%. So in other words, despite economic downturn and pandemic, investors actually remain quite healthy in terms of mortgage payment. Now, this might be the result of government subsidy or the economy rebound or a combination of both. So, so the economy rebound is being reflected in the GDP chart that I have shared earlier already. And quoting from the Canadian Real Estate Association, if we look at the home price index across Canada, you'll see that the trend has mainly been upward in the last 16 years. So there's a small dip after the foreign buyer tax being initiated. However, it rebounded steadily, even during COVID. Now, one simple fact is low rate makes investors to move money outside GICs and bank savings account because the return of these investments cannot even beat the inflation. If we look at the 10 years inflation rate data and average it out each year is at about 1.8% inflation, while GIC is actually generating less than 1% return right now from a yearly perspective. So also we're seeing investors concerning currency depreciation. So therefore money is being moved into other assets such as stocks, real estate, and alternative investments, including GMIC. So we have covered the macroeconomics, rate, and housing at the earlier part. Now, the next part we'll introduce our product GMIC. Fund name is Genesis Mortgage Investment Corp. Again, managed under Gentai Capital Corporation. Now, for existing investors, you have already experienced the benefits. However, for some of the audiences, it'll be the first time hearing it. So I'll provide some highlights, and if you're interested to invest with us immediately or simply want to know more before making any decisions, please contact me afterwards and I'm open to chat. So let's go into history a little bit. So MIC has been created by the federal government since about 50 years ago. Now, despite it might be its first time to you, like I said, it has a long track record and is created by government. So in recent years, there has been a pickup in demand. So it's only 1% of the residential mortgage market. So therefore, there's still a very big room to grow. And when it comes to mortgage investing, which is related to housing, location and demand are important factors in terms of risk control, as most of the MIC loans are concentrated in immigration and employment cluster cities such as Vancouver and Toronto, instead of a not so demand location like Northwest Territories. When there's demand, real estate price correction risk is way smaller, and the support right there is way stronger. So we'll go into detail later how this support of real estate price would actually translate into safety for MIC investors. So to help you understand GMIC, let's take a look at how we operate. So first, on the left-hand side, you see GAMC, which is the sell side. Investors would invest money through GAMC, and money would be put into GMIC, so which is our pool of money. So that pool of money is being managed by GCC, Gentai Capital Corporation. And for any of the money we lend out, right, we charge around a 10% interest rate and minus a 2% management fee. Then we distribute the 8% remaining back to investors. Now, we're also well recognized by major institutions such as Canadian Western Bank. We receive a line of credit of 25 million from CWB, and then the room has been increasing steadily. In the last 8 years, we start at 3 million from them, and then right now we increase to 25 million. So the Canadian Western Bank look at our financial statements very regularly, monthly and quarterly. So it shows that our financials are healthy. So that's why they keep on increasing the line of credit. Now, let's look at how we get the 10% rate from borrowers. And in order for investors to understand that, we'll have to explain the difference between the loans that we do versus the loans at banks. So banks focus on salary earning borrowers, which means income focus, with a 20 to 30 years amortization period. While at Gentai, we focus on short-term loans, typically 6 to 12 months, and high net worth or ultra high net worth instead of salary earners. So these short-term loans borrowers, the high net worth, the wealthy, they don't fit into bank model because they don't base on income. So now that doesn't mean that they are not good quality, as I mentioned, because they are very wealthy. And not only that they are wealthy, we actually need them to have a good credit score over 650. And they also need to put up 100% collateral and be personal unlimited guarantee if they want to apply to borrow money from us. And even with that, we typically only approve about 10 to 15% of the applications. Now, we don't worry about sending business away because we have a very healthy pipeline of 3,000 lending agents. I might have mentioned at the earlier part of the presentation. So 3,000 lending agents work with us across the whole country, keep on sending deals to us, so we can actually cherry pick which are the good deals. So like I said, many of these borrowers are business owners or angel investors, and these short-term loans mainly are used for real estate rebuild, project developments, etc. So therefore, 20 to 30 years doesn't fit their model as well. So I'll give you one example. So so this is actually it happens very frequently at the last quarter. So location at Richmond. So this one right here, the third party appraisal is at 1.96 million. And then we loan about like 859,000 to that borrower. So it's the first mortgage position. And if we do a calculation, the loan to value ratio, the 800 something divided by this is at about 44%. And we charge 7%, about 7% rate. Now, remember that I explained I said that I'll explain the relationship between the properties itself and the loan, and how do we control the risk in case of any market downturns, right? And then continue to deliver result to investors. So so at this slide right here, I can explain a little bit further. Now, key point is looking at the loan to value ratio. So if there is a drop in the real estate price, it will hit the homeowner's equity before hitting the loan itself. So in other words, the part of the between the 1.96 million to 859,000, which is about the first 56% of the home equity value owned by the homeowner itself, would actually get hit first before hitting you. Okay, so you at the bottom part right there, 44%. So you're at the bottom part. The first part would take hit, all right, if there's any price correction. So in other words, which means that you actually get a 56% buffer to protect you, all right, before it hits the mortgage investors. So the chance of hitting you is actually quite low. And then the second example, pretty much the same thing, but this is actually a bigger project. So this one in Vancouver as well. So 8 million third-party appraisal. We loan out 3.85 million, and there is actually another mortgage provider in this one, but it's not listed right here. All right. So our position is the second mortgage. So the total loan to value is 62.5%. So which means that which means that the combined loan together is 5 million. Okay. And then but we loan 3.85 out of that 5. And we charge about 11.25% right here. Now, let's take a quick look about like the geographic location and stuff. We don't need to go into details, but the reason why I show you this chart is because I want to make sure you know that we actually try to diversify across everywhere. So most of them are urban areas, like BC, and we're actually growing our portfolio in Montreal and Toronto as well. All right. So whenever we see great opportunities, we would go in. So we don't limit ourselves to close to our headquarters, which is Western Canada, but we actually like I said, we actually have a healthy pipeline across the whole country as well. We even get deals in Edmonton too. Yep. So you can see that. All right. And then this chart right here also shows that diversify among different types of properties, such as residential, commercial, and then land and construction. So risk is diversified instead of focusing on like one single type of properties, hence it can lower the risk. Now this chart right here also shows that we actually receive a different interest rate from different loans, all right? So from the 80 loans, we have some range at the lower part, which is like below 8, and we have some range higher at the over 12%. And then on average, as you can see right here, we hit the 10.11%. So that's as of March 31st, year 2021. And then again, minus the 2% management fee, the net result is about 8%, as per my demonstration at the earlier part of the presentation. And this one right here, very important as a lender. So as a lender itself, mortgage possession is very important to us. And 99% of our mortgages are first and second in possession. So which means we have the right to be in front of the line to collect the money if anything goes wrong. So think of it from a stock market perspective. We are the preferred shares versus the others of common shares owners. So we get the first step, and that's additional security. Now, in summary, we've funded over 500 million in the last 8.5 years, over 400 deals, average at 10% interest rate, and loan to value will keep it around 60 or lower like 50. So that way it gives investors a good buffer if there's any real estate price correction. Now, all these are the reason we deliver steady result without investors losing a dime in the last 8.5 years. Now, once again, thank you very much for attending. And if you are interested to find out more, or if you're interested to invest immediately, please contact me or contact any one of our representatives that lives close to you, and we will be happy to assist. Appreciate it. Thank you.